So this year has been quite extraordinary in terms of geopolitical events and also market reaction. So what worked well in 2016, especially from a sterling base, would be overseas investments, whether they be equities or bonds, and also from a sterling base, UK fixed income. So looking forward to 2017, clearly there are further issues. The French election will be absolutely key in our view. However, we're reasonably optimistic, cautious optimism, if you like, in terms of the portfolio structure. We're overweight equities and we have other risk assets. 4 themes I'd like to address: FX related, sterling; bond related, short dated bonds; European equities within the equity market; and also within debt, somewhat specialist, but financial debt. So in summary, in terms of FX, especially investing from a sterling base, being out of sterling was really additive to portfolios. We see sterling as somewhat oversold and actually cheap on a purchasing power parity basis. So have a look at the article on that. What does that mean? Potentially higher sterling exposure next year, 1. In terms of fixed income, yields are low, but one area that is interesting is credit. Credit, or the additional spread, the additional yield you earn, is actually about fair value. So take out some of the interest rate risk that is inherent in bonds and focus just on credit for next year can be interesting. Also within bonds, we really like financial credit. Put simply, the issue with banks is more profitability, not solvency. You're overcompensated for risk of defaults within the major banks, the major national champion banks in our view. And finally, within equities, we like equities still, but especially European equities. Huge outflows in 2016 from European equities. That tends to be a contrarian indicator. And actually, when we look at the growth indicators, we're seeing some strength come through.